Right now, across America, dealership lots are overflowing with trucks carrying price tags so outrageous they make your jaw drop. Trucks that used to be tools for work are now parked under spotlights, with stickers rivaling luxury European sedans. Some are pushing past $160,000, more than the median price of a house just a decade ago. And they're not even rare special editions. We're talking about regular F-150s with bolt-ons, badges, and a lift kit. But here's the strange part. Ford just reported its best truck sales in years. On paper, the market looks stronger than ever. Yet if you walk onto one of these lots, you'll see row after row of unsold metal quietly gathering dust. Something doesn't add up. The headlines will tell you it's inflation, or interest rates, or maybe supply chains, but that doesn't explain why dealers are still ordering trucks they can't sell, or why automakers keep building them at prices most people could never afford. It doesn't explain why trucks with $80,000 plus price tags sit for months, while the few basic trims vanish in days. And it definitely doesn't explain why Ford's record sales quarter looks very different when you talk to the people actually trying to move these trucks off the lot. Because there's something else happening here, something far more deliberate. A shift in the way America's most important vehicles are priced, produced, and pushed onto buyers. It's not about making trucks better. It's about changing the entire game so the only way forward is paying luxury money for what used to be everyday workhorses. But here's where it gets even stranger. Ford isn't alone. This is part of a wider strategy that's rippling through the entire truck market. And the real story isn't just about high prices, it's about what happens when the math behind those prices stops working. So why are manufacturers pushing pickups into six-figure territory, even as lots fill with trucks nobody's buying? How can they report record sales while dealers quietly drown in aging inventory? And what does it mean for you if you're thinking about buying one in the next year? The answers aren't what you think, and they're hiding in plain sight. Buried in sales reports, dealer incentive sheets, and a set of tactics the industry really doesn't want you to understand.
You'd think prices this high would mean trucks are loaded with cutting-edge tech, gold-plated interiors, or some breakthrough engineering that justifies the sticker. But here's where it gets wild. Most of these six-figure pickups aren't that different from trucks you could have bought 5 years ago for half the price. The biggest change isn't under the hood. It's on the invoice. Let's put this in perspective. Right now, the average new vehicle in the US sells for around $48,000. That's already a big number, about what a brand new BMW 3 Series cost not too long ago. But full-size pickups, they've blown right past that. The median price for an F-150 today lands in the low to mid $60,000 range. That's before the dealer adds a lift, a fancy wheel package, or one of those limited edition appearance kits that adds thousands without actually making the truck work any harder. And yes, that means the cheapest versions, the bare bones work trucks, are almost extinct on lots. So how did we get here? You can trace the turning point back to 2020, right in the middle of the pandemic. Supply chains were wrecked, factories slowed to a crawl, and suddenly there just weren't enough new vehicles to go around. Dealers were selling every truck they could get, often at or above MSRP because buyers were desperate. And here's where the plot twist kicks in. Consumers got used to those high prices. Automakers saw that we'd pay them and decided to make that the new normal. Instead of bringing prices back down when production recovered, manufacturers doubled down. They cut production of low-trim trucks, ramped up the expensive ones, and created the illusion of premium by stuffing in cosmetic upgrades. It's the equivalent of charging 5-star hotel rates for a regular motel room just because they swapped the bedspread and hung a flat screen on the wall. But what if I told you this wasn't just about making more money per sale? It was about changing the DNA of the truck market entirely. Because the moment you stop competing to sell the most trucks and start competing to sell the most expensive trucks, you've entered a completely different game. And that game has a very dangerous flaw, one that's already showing up in Ford's own sales data.
Earlier this year, something happened that made Ford's sales charts explode. In a good way on paper, but in a dangerous way in reality. And it all started with a single announcement out of Washington. Back in January, the Trump administration floated the idea of new tariffs on imported vehicle components. Now, most people hear tariffs and their eyes glaze over, so let's break it down simply. Tariffs are basically a tax on goods coming into the country. If those taxes go up, the cost of making trucks goes up, which means the sticker price at the dealership would go up too. The moment those headlines hit, buyers panicked. Word spread that vehicle prices might jump overnight. So people rushed into dealerships in February and March to lock in a truck before the inevitable increase. It was like watching people raid a grocery store before a hurricane, except instead of bottled water, it was $70,000 pickup trucks. Dealers suddenly couldn't keep inventory on the lot. Their orders to Ford skyrocketed. Ford, seeing the feeding frenzy, ramped up production and shipped out everything they could. And here's the thing about the auto industry's math. When Ford ships a truck to a dealer, that counts as a sale for Ford's books, even if it just sits on the lot for months afterward. So those Q2 numbers, they looked amazing. Over 200,000 F-Series trucks sold in one quarter, the best in 3 years. Wall Street loved it. But wait, this next part changes everything. That buying rush wasn't natural demand. It was pulled forward demand. People who were going to buy a truck later in the year just bought one early. Which means when you fast forward a few months, there are fewer buyers left, but the same amount of trucks coming from the factory. Now dealers are sitting on huge inventories of high-priced trucks, and the panic that cleared their lots in spring has been replaced by silence. And this is where something called channel stuffing comes into play. That's when a company pushes a ton of product into the distribution network, like dealers, to inflate short-term sales numbers. It makes the quarterly earnings look great, but it can leave the people actually trying to sell those products in a chokehold. And right now, that's exactly where many Ford dealers find themselves.
If you really want to see the cracks in the strategy, don't look at Ford's sales reports. Look at their lots. Because right now, the real story is written in dust on the windshields. Here's what's supposed to happen. New vehicles should move within 40 to 50 days of hitting a dealer lot. That keeps inventory fresh, interest costs low, and customers seeing new rather than leftover. But take a walk through many Ford lots right now, and you'll see trucks, especially the $80,000 plus models, sitting for 70, 80, even 90 days before anyone signs the papers. Some have been parked so long, they've been moved to the back rows, out of the prime spots, just to make room for more arrivals they don't have space for. And here's where it gets even more revealing. Ford isn't slashing prices in public. That would blow up the whole premium price image they've spent years building. Instead, they've started quietly feeding dealers more support money. Think of it like a secret cash allowance from Ford to the dealer, letting them offer a discount without officially lowering the MSRP. To the casual shopper, that $92,000 sticker is still there. But the salesperson suddenly finds a way to knock off 10 grand if you're ready to sign today. Why do it this way? Because the illusion of value is everything in a luxury margin strategy. The sticker says you're buying a premium truck. The discount makes you feel like you scored a deal. But in reality, Ford's just trying to move metal without admitting the market is starting to push back. And here's the kicker. These hidden discounts are growing. Industry data shows high-end F150s are seeing 12 to 18% knocked off behind the scenes, meaning dealers are eating or offsetting $15,000 to $25,000 on some of these trucks. That's not the behavior of a product in unstoppable demand. That's the behavior of a product running into a wall. But it gets crazier, because these discounts aren't across the board. The rare basic trucks, the ones without the luxury badge packages, without the giant wheel upgrades, are moving so fast they barely touch the lot. In some places, they sell in under a week. And Ford knows this, but still builds far fewer of them than the high-end ones. Why? Because the whole business model is built on convincing you to stretch for the expensive trim. And here's where the problem deepens. That same strategy is now colliding with another Ford bet that's not paying off like they hoped. Ford's gamble on high-priced trucks wasn't just about gas engines. They were banking hard on electric pickups too, and that's where the cracks are starting to show in a big way. When the F-150 Lightning launched, it was supposed to be a revolution. All the marketing framed it as the truck of the future, quiet, fast, and clean, but still every bit a workhorse. And for a while, demand was so hot that early buyers were paying well over sticker just to get one. But fast forward to 2025, and the story is very different. Sales of the Lightning have slowed so much that the average Ford dealer is moving barely one a month. Think about that. An entire section of the lot, dedicated to a vehicle Ford spent billions to develop, is turning at a snail's pace. And this isn't just about customers not wanting EVs. It's about the price tag. Most Lightnings are stickered around $90,000 once you add the features people actually want. That's nearly double the price of a base gas F-150. For a lot of buyers, no amount of instant torque or futuristic tech can justify that. The problem is, Ford built their EV truck strategy around the same luxury margin thinking they used for their gas lineup. Fewer trucks, higher profit per sale. But here's where it backfires. Because unlike gas trucks, the EV market is changing fast. Rivals are cutting prices, buyers are getting picky, and government incentives are shifting. And when you're sitting on $90,000 electric trucks that aren't moving, the carrying costs pile up even faster than they do for the gas models. It's already hitting the books. In Q2 2025, Ford's Model E division, the part that makes EVs, posted a $1.3 billion loss. That's with revenue actually going up. Translation, they're selling more EVs than last year, but losing more money doing it. And if the Lightning, their flagship EV truck, keeps moving at a crawl, that hole only gets deeper. But what if I told you the EV slowdown isn't just a Lightning problem, it's feeding directly into the bigger pricing crisis? Because when one side of your truck strategy stalls, the other side has to pick up the slack. And that means doubling down on pushing gas trucks even harder into the luxury zone. And that brings us straight to the part most buyers actually feel in their wallets, how the affordability of trucks has been quietly destroyed over the last few years.
If you really want to see how far the truck market has drifted from reality, forget the MSRP for a second. Look at the loans people are signing to afford these things. The financial rule of thumb is simple. You shouldn't spend more than about 15% of your monthly income on a vehicle payment. For the median US household income, around $71,000 a year, that means a new vehicle should cost in the ballpark of $35,000. But here's the problem. The average new truck is almost double that. Even a mid-tier F-150 can land you in the $65,000 to $75,000 range before taxes and fees. So how are people buying them? They're stretching the loans further and further. 10 years ago, a 5-year loan was standard. Now, 72 months, 6 years is common. And a record number of buyers are signing 84-month loans. That's 7 years of payments. For context, that's like still paying off your truck when the next generation of F-150 has already gone through a full redesign. But here's where it gets worse. Those long loans mean you're underwater for years. Underwater just means you owe more on the truck than it's worth. So if you need to sell it or trade it in early, you're stuck either bringing thousands of dollars in cash to cover the gap or rolling that debt into your next loan. It's like stacking bricks on your back and trying to run. You can do it for a while, but eventually it's going to crush you. And the real trap, the few affordable new vehicles that used to be the safety valve for the market are vanishing. In 2015, nearly a quarter of new cars sold in America were under $30,000. Now that share has collapsed to around 13%. And in many truck lineups, the low-end trims are basically mythical creatures, talked about but rarely seen in the wild. Dealers will tell you they can order one, but they almost never have one on the lot. Why? Because they'd rather sell you the expensive one that makes them more money. This is why used truck prices have gone up too. When the new ones are out of reach, everyone piles into the used market, driving those prices higher. And suddenly, even a 5-year-old truck with 80,000 miles is going for $35,000 to $40,000. That's supposed to be the budget option. But it gets crazier, because all of this, from the long loans to the disappearing base models, is only possible while buyers believe the trucks will hold their value. And that's the next domino in the chain, one that's starting to wobble.
The whole luxury truck strategy depends on one fragile belief, that these trucks will keep their value long enough for buyers and lenders to feel safe. The moment that confidence cracks, the entire structure starts to shake. And right now, there are signs it's already happening. Across the country, dealer lots are holding more trucks than they can realistically sell, especially the high-end trims. In a healthy market, trucks might sit 40 to 50 days before selling, but for models priced over $80,000, the average is now creeping into the 80-day range. That's not just slow, it's expensive. Every day a truck sits, the dealer pays interest on the loan they took out to keep it in inventory, known as floor plan costs. Multiply that by dozens or hundreds of unsold trucks, and you're bleeding cash before the wheels even turn. So dealers start pushing for faster turnover. And Ford quietly boosts incentives to help them. But here's the key. They don't advertise these cuts like a clearance sale. That would ruin the premium image. Instead, they hide them in the deal-making process. Secret rebates, bonus cash for financing through Ford Credit, loyalty incentives, trade-in boosts. The sticker says $92,000, but if you know how to negotiate, or if the dealer is desperate enough, you might walk out with it for $75,000. The average customer never realizes just how flexible those numbers really are. And here's where the bubble risk comes in. If the market tips, say from a mild recession or another spike in interest rates, or even just buyers collectively deciding enough is enough, those discounts will have to go public. When that happens, resale values will take a hit, lenders will tighten credit, and buyers who paid full price will be trapped in negative equity overnight. It's the same kind of cycle that's hit housing markets in the past, but here, it's sitting on 4 wheels. The irony is that Ford already has the solution sitting on its lots. Their commercial trucks and vans, the Transit, the stripped-down Super Duty fleet builds, are moving quickly at fair prices because they're priced for utility, not status.
They prove Ford can still make a capable, reasonably priced vehicle and sell it profitably. But as long as the focus stays on chasing luxury margins, the company is playing chicken with the market. And here's the wild part. When the correction comes, it might happen fast. The moment carrying costs outweigh the illusion of premium pricing, dealers will start slashing prices just to get out from under the inventory. And that's when the six-figure pickup era could collapse overnight.